Okay, so there are playbooks for when the stock market is ripping. Buy call options on GameStop and just ride it to the moon. And when the market is crashing, short everything you can and just hold on for dear life. But what can you do when the market decides to flatline to still give yourself an edge and make a solid return? Enter the powerful options trading strategy known as the short strangle. This option strategy is super powerful when the market is not going up. It's not going down. It's always when it is range bound like this. Here's a great example, and here's how it works. I'm going to get you an example in a real trading account in a second. But when you have a stock that is trading sideways or has flat line like a heartbeat, you got the little blips, then you just go, you want that flat line market, and this is how you can make it work. You want to have a range at the bottom of the stock that's trading in between. This example for Apple here, the low point there is 165, and the high point, if you take it to the other side, is right up there around 195 and change. Let's put it up there. So those are your two kind of ranges that Apple's been trading within since last April, okay? Now, what we want to do is we want to take the bottom leg or the put leg, and we want to go ahead and sell. We want to sell down here, sell a put, okay? We want to sell a put. And at the top end, we want to sell another contract. We want to sell a call option. We're going to move this over to the right. So those are the parameters of how this strategy works. But you have to make sure that you understand a couple things, because if the stock does approach one of these two, you have to understand how to defend your position if it doesn't go your way. In a perfect world, the stock keeps trading within that range and you bank the premium that you get by selling these options, okay? When I look at it inside Interactive Brokers in a second, it's going to make a little bit more sense. What we want to do here is find that level of support. And if we have 165 here, maybe we can move it up a little bit higher and say, hey, in the next kind of 30-ish days, based on your expiration date, maybe we'll make it a little bit more aggressive and go 170. We'll also look at the delta in a second and get a second opinion on that based on the delta for the option. And we're going to bring this down a little bit more down to about this level here, around the 190-ish area. Given that Apple's kind of been retreating from higher highs, it's making a little bit kind of a low kind of area down here. So hopefully this trends a little bit lower in this example. So now on the put side, the low side, we've got 170. We're below the stock price of Apple at 181. And we've got a call right around the 190, 195 area. Let's flip into Interactive Brokers and see how it looks for premium that we're going to receive. We are in here. We are in Apple right there, right? We have the options chain open up right here. We want to go back and go out to the March 15th, 18 days away. Let's see what the options premiums are like for this type of trade. At the 170 area, we put on our strategy builder here. And you can do a combo options trade. We're going to sell this put at 170. We're not getting paid too much because it's only 2 weeks away, 2 and a change. And then we'd also go down and we would then sell at the 190 or 195 strikes. And again, let's go 190. Also taking into account the deltas on these two trades, okay? The delta, it's going to tell you the likelihood of that trade or that leg of the trade being approached and passed at this moment in time, making this trade. So an 8% chance on the sell side for the put, a 14% chance for the call option that we are selling. So very, very minimal odds there for this getting approached. And again, we can then go see our total premium there, about $95 for this trade. We go the middle between 0.96, 0.94 would be getting paid. We'd go put that in our limit area down here, 0.95. And then we could go in and say, hey, give me some advanced metrics on this trade. This is why I love using the short strangle in certain scenarios, because it has a very high win probability. If we go into our performance profile, you can see we have a profit probability of 83%, a max return of that $94. It's 95 less commissions. The only downside here is to understand that you have unlimited potential risk on this trade, which is why most people or most newer traders like to turn these short strangles into iron condors by just taking it one safe measure of precaution. I'm going to show you in a moment. But for the short strangle itself, you have a great profitability percentage of 83%. And you don't have to tie up that much margin in your account to do this. You do have to understand what happens when these different areas get approached. For example, if the stock was to come in here and we had to sell this Strangle right for 95, and then the stock price started to drop lower, and it started to approach our put option down here. Well, we would be in a negative cash flow position because this call up here, we'd make like pretty much bang for our buck right there, which is probably like 50 bucks. Okay. But the value of this put option would be going the opposite direction at a greater rate than this $50 premium up here. So we would be negative on this position, a few $100s. And you can also check this in your performance profile interactive brokers here if you use that for your trading. If we go into advanced again, it shows you at the bottom what happens for your profitability if there's a 10% negative move, a 10% positive move. We want it to stay pretty flat. So if any of this kind of happens 10, 20% either direction, we're going to be losing cash. The P&L there showing negative 670, negative 900. So we want it to stay hunky-dory in the middle for this strategy. If it did approach this area over here, what you need to do or be prepared to do is close this leg. Okay, you need to close this leg off and accept this capital loss and just be okay with it and say, hey, I made a mistake. I made a bad call in the trade. It went against me for whatever reason, and just move on to the next trade. Don't try to dig your heels in and wait for this to kind of bounce back up. It may not, it may push through, and that's worst case scenario right there. If you wanted to go ahead and do this, you could close off this leg by buying it back. The other option for you, of course, is to just accept the assignment of these shares if you wanted to do so. That's if it goes lower. If it was to creep higher, it would be the same thing right here, right? Your put that you sold, you'd be making big bucks there, 40-ish dollars on the put side, but the call option would be so far in the negative, it would outweigh any profits from this leg. You'd be in a negative cash flow position. Again, if the stock price gets up to here or even goes past it, if it does reach and breaks above, you have to be willing, if you're going to hold on to that call option that you sold, to sell 100 shares of stock. If you don't currently own 100 shares of Apple and you let this thing expire and the stock price ends up being up here around anywhere above your strike price of 190, you are going to either have a short position of 100 shares, which is negative 100 shares in your account if you didn't have any shares of Apple. If you did have 100 shares of Apple, they would be sold off automatically after this contract was exercised / expired at your strike price up here around 195. So understand that. And if you don't want that to happen, close this part of the trade out and close it out for a loss if it gets approached when this trade is live. Again, this works best when the stock or the market is going like a flat line of a heartbeat, just straight across or very tightly range bound, where it's not going to break through these key levels here and here. And if you do want to put on some protection and quickly change this into a safer iron condor, all you would have to do, right, is just change the leg. And instead of just selling both legs by themselves, you would then turn around and buy another leg a little bit lower out on either side, a little bit further out of the money, as it said, and you would change your Strangle into a beautiful risk-adverse iron condor with the very similar profitability potential. The only difference being here, if we're going to go in here and just make this 56, your profitability percentage isn't going to change really. What's going to change is your max return. It gets cut down from $96. It gets cut in half to 54, but you can also see that your max loss is protected with an iron condor versus a short Strangle. But with the short Strangle, there's more bang for your buck. You get more premium captured. And if you understand how to manage your position correctly, you can do so and receive a nice jolt of premium in your account while the market or stock has flatlined. You're still making bank, you're still making dollars. It's that easy with this option trading strategy. If you got some value out of this video here today, please subscribe to the channel for more. Thank you for watching this video all about short Strangles, and I will catch you on the next one.